Good afternoon, everyone, and welcome to the fifth webinar in our Blockchain at Butzel series. So you want to buy a blockchain company, considerations for corporate transactions. During this afternoon's presentation, please feel free to submit questions to our presenters using the Zoom Q&A panel. A copy and recording of this presentation will be made available on the webinar event page on butzel.com. I am pleased to introduce our presenters today. From Butzel Long, we have shareholders William Kraus, Jennifer Dukarski, and Laura Johnson. Bill Kraus represents individuals and businesses in governmental and regulatory investigations, U.S. state and federal litigation, and alternative dispute resolution. He concentrates his practice on disputes relating to the financial industry with a particular focus on legal and regulatory issues related to digital assets and blockchain technology. Also joining us is Jen Dukarski. She focuses her practice at the intersection of technology and communications with an emphasis on the legal issues arising from emerging and disruptive innovation, digital media, content, vehicle safety, connected and autonomous cars, shared mobility, infotainment, data privacy, and security. And finally, we have Laura Johnson. Laura practices in the areas of mergers and acquisitions, nonprofit organizations, corporate governance, entity formation, and general corporate and business law. She advises clients in venture capital and private equity transactions. With that, I want to thank everyone again for joining us, and I would like to pass the baton on to Bill Kraus. Bill?
Thanks, Jonathan. Over the last few months, we've been rolling out a webinar series examining the law and regulations surrounding digital assets and blockchain. I'm calling this Blockchain at Butzel. And as Jonathan did, I'd like to welcome you as well to the fifth webinar in the series. Thank you for the opportunity to speak with you today. As Jonathan also said, I'm very excited to be joined here by Jennifer Dukarski and Laura Johnson, fellow shareholders and colleagues at Butzel Long. As some of you may know, looking to Jen, this is the second Blockchain at Butzel webinar she has joined, and she really brings a wealth of experience to our discussion today regarding emerging technologies, as Jonathan touched upon. And if you're interested, I'd encourage you to check out a fascinating webinar we had done a couple of weeks back regarding blockchain applications in the automotive industry. You can find that on Butzel's website and YouTube, as well as recordings of all the previous Blockchain at Butzel webinars that we've done. I'd also like to welcome Laura Johnson to our discussion. Laura is one of our resident rock stars in corporate law and has prepared some really great material for us today regarding these kinds of transactions. I think with everyone's contributions, this should be an informative and useful presentation for folks. As always, we want to make sure that this webinar is useful for everyone in attendance. So please, if you have any questions, don't hesitate to post them to our panelists via the Q&A function. We will plan to answer those at the end of the presentation. So with that, let's get started. So Jonathan, if we could have the first slide, please. All right. So with apologies to anyone who has attended one of my previous webinars, I like to go and just give a quick refresher topically, because I find that a lot of folks are interested in digital assets and blockchain, but sometimes, there's this sort of jargon barrier that folks have to get through in terms of what we're talking about. And, even though it's interesting, folks might think this is complex tech or might not just understand the basics. So I want to deconstruct that a little bit. Here's a very quick refresher on blockchain. While Bitcoin is sort of the most well-known technology in this space, and I think is a revolutionary technology, not everyone is aware that Bitcoin really brought blockchain technology to the masses as well. In my opinion, that contribution is equally as significant, if not more so, than Bitcoin itself. So what do we mean when we talk about blockchain? Well, at its core, you think of blockchain as just blocks of records, okay? String of data, whether it's transactions involving Bitcoin or entries, related to the manufacturing of a widget or whatever the case might be, strung together piece by piece and organized in a block. Those blocks strung together create a blockchain. I mean, that's a gross oversimplification in a lot of ways, but fundamentally, you can just think of blockchain as an immutable electronic ledger storing data. And for this reason, there's a lot of really cool applications of blockchain that folks have already sort of waded into, and others that are being explored now, and more so that will be explored in the future. So what are some basic characteristics? Well, like I said, It's a permanent or immutable electronic ledger. Okay, that means that folks cannot easily change or tamper with it. And, as the case in Bitcoin, the Bitcoin blockchain really shows every Bitcoin transaction that has ever taken place. People don't necessarily understand that, but we could go and track transactions backwards since the start of Bitcoin. It relies on a distributed ledger. Well, what does that mean? It means that the data, the repository of records, is shared by multiple entities. You can have different kinds of blockchain. You can have a decentralized blockchain in which folks outside of organizations, say with Bitcoin, are able to have a copy of the blockchain, or you can have a centralized blockchain as well, in which the distributed ledger might be shared among parties within a corporation and private. What's cool about blockchain, among other things, is that it allows parties to transact without the use of a trusted intermediary. You don't need to go and, say, involve a bank with a Bitcoin transaction. You can just directly interact with your counterparty. And moreover, it's what's called trustless. Okay, so blockchain allows for self-verification of information in a way that we can go and interact with parties whether we know them or not, without the need for an intermediary to say, yes, the assets that this person is purporting to send you, they actually hold, or, that they are verified or able to, authenticate the data that they are sending. It's also secured by encryption and is tamper resistant, and blockchain can store a massive amount of information and create a mathematically verifiable audit trail. So, as I said, for this reason, businesses in nearly every industry have explored and started applying blockchain. And it's my opinion that this trend will only continue as more companies become more familiar and more confident using the tech. So why are we interested? What are some of the applications? Well, that could fill another webinar in its own right. In fact, we have filled at least 1 or 2 webinars talking about that. But you can provide a perfect audit trail, resistant tampering by any one actor. Blockchain can efficiently track regular and frequent transactions without the need for manual data entry. It can facilitate extremely fast transactions and assist with things like supply chain issues and logistics, et cetera, et cetera, et cetera. If you really think of it as an ironclad data system, okay, in a way of sharing information or transmitting data, the possibilities are really endless. So, Jonathan, if we could have the next slide, please. One back, there we go. So, not surprisingly, we're seeing large and well-established companies exploring solutions, as we've discussed, but we're also seeing a number of startups, smaller businesses looking to get into this space. And, with that, we're also seeing corporate transactions sort of on the upswing. And in fact, there's a number of opportunities here that I think businesses are seizing on to go and expand their business, to get into hot areas, or to sort of just lean into this technology as it continues to grow and become more widely adopted. So I'm going to talk here about a couple of recent transactions. I'm going to touch upon some trends that I think we're seeing in the market before we get into the nuts and bolts of transactions. So here are 3 examples. I'll go through them quickly. The first, Nuvei, is a $10 billion payment solution provider that facilitates really everything from online to mobile app payments to in-store and alternative payments like PayPal or Apple Pay. It was reported just a couple of weeks ago that Nuvei has agreed to acquire a crypto payment processor called Simplex for $250 million. So why should we care? Well, Nuvei has experience already in processing assets, but Simplex is a very, very prominent business in this space and is expected to strengthen the company's ability to buy and sell digital assets and convert it back to fiat currency, which is an increasingly in-demand service. As an example, PayPal recently began offering very similar services, letting its users buy, sell cryptocurrencies, as well as use digital assets to check out wherever PayPal is accepted, which I believe is roughly 30 million different retailers online. In short, the need for businesses that can handle the logistical and legal/regulatory aspects of payment processing with digital assets is only going to increase, right? As more folks want to, accept Bitcoin here, or, offer payment processing solutions to take advantage of some of the advantages that digital assets have. It's also notable that Simplex is a principal member of Visa, and has permission to issue Visa cards, which is speaking really to another trend that we're seeing in the space of digital assets becoming more a part of traditional finance every day, and retail customers actually looking for opportunities to use digital assets, right? Whether it's using them to pay for products or to actually receive, crypto rewards or Bitcoin rewards as an example for credit card usage. So another recent transaction, which I think was interesting, was the acquisition of crypto custodian BitGo by Galaxy Digital, which is a crypto merchant bank. So what's a crypto custodian? Well, I like to think of it kind of like, a safe. A crypto custodian is a business that stores and safeguards digital assets on behalf of customers. BitGo is one of the larger businesses in this space, and we're seeing that as more businesses incorporate digital assets, whether as a treasury reserve or something that they will accept in exchange for goods and services, and retail adoption continues to increase, that the need to safely store and safeguard digital assets is not surprisingly in demand. Another recent transaction I think speaks to some broader trends is Dapper Labs. Dapper is interesting because it's an NFT focused startup that was behind the popular NBA Top Shot NFTs. If you're not familiar with that, NFTs, not fungible tokens, again, that could be the subject of our own webinar. We've touched on that in the past, but it's a really cool idea in which you basically have these sort of, short films of amazing moments in the NBA, right? That people can go get a one-on-one copy of, like a signed trading card. And, there's a business opportunity here that I think folks are starting to explore. In March, Dapper completed a $305 million funding round with a $2.6 billion valuation, and then was reported to begin another funding round at a $7.5 billion valuation since that time. And this kind of raise really reflects what I think is growing interest in NFT platforms and marketplaces, while speaking to a broader trend of NFTs actually providing a product that businesses want to explore. So if we could go to the trend slide, Jonathan, we'll expand upon that a little bit. So there was some really good analysis that was done recently by The Block, which is a kind of leading research and analysis firm in this space. By their calculations, there was 314 total investment deals in Q1 2021 with an average deal size of $12.7 million. That makes 21 on track to become the largest year in private funding in blockchain/digital assets. And as I think you could take away from my example, what we're seeing is a really huge uptick in venture funding and private investment related to digital asset-based financial services. Okay, and again, I touched on some of this. It's driven a lot by institutional demand for digital asset exposure. Folks like Tesla, et cetera, saying we're going to now hold Bitcoin as a long-term investment, but also retail demand, which I think is really growing for digital asset-based financial products, ETFs, exchange traded funds, credit cards. Even there's a lot of talk of 401ks, being expanded and custodied in a way that will allow folks to bring on that exposure into their retirement portfolios if they choose. Before this year, that really was a very niche product that not a lot of folks would think about. We're also seeing digital asset businesses increasingly entering spaces that were traditionally relegated to traditional finance. I think I said traditional about 3 times there, so I apologize. Credit, lending, payment services, asset management, all of this counsels in the need of companies wanting to onboard custody solutions quickly, payment processing solutions quickly, businesses looking to acquire expertise and technological capabilities fast. And that's really where we see these transactions spring up. Other trends, and I'll stop talking after this, NFTs, gaming, enterprise solutions, data information management, all great applications of blockchain that are being explored right now. So how do we navigate a transaction involving distributed ledger technology or blockchain? Well, for that, I'd like to hand this over to my esteemed colleagues and Laura Johnson in particular to speak about the deal process.
Thanks, Bill. Next slide here. Thanks. So now that we have an understanding or a refresher about blockchain companies, and we've seen the recent trends and the number of acquisitions and prevalence of these types of companies, we're going to get into a little bit more detail about what a transaction involving a blockchain company might look like. And a lot of the points that we'll be discussing today will be discussing general overarching themes of just an M&A deal. And then we'll dive a little bit deeper into what kind of nuances you might see or specifics you might see when it comes to the acquisition of a blockchain company. So overall, just the deal structure, every single deal is a little bit different. The process of every deal can be different, but you will see some similarities in the deal process and transaction. So first of all, if you're interested in buying a company, you have to find that company. You have to find a target that you're interested in. And this is just done various ways. You can hire a broker to go and seek a potential seller. Oftentimes sellers who are looking to sell their company will hire a broker similarly to find buyers. Oftentimes you come across a company just by word of mouth or direct communications that you're interested in, and that's how you locate a target company. The next stage, in addition just having initial discussions, is putting together a letter of intent. Sometimes it takes the form of a term sheet. You might hear that as well. Not every single deal has a letter of intent or term sheet. Sometimes people just jump right into the next stage of the process. But if there is a letter of intent or a term sheet, that would set out just the basic terms of the deal, what the parties might expect to be in the final agreements. In general, most provisions of a letter of intent or a term sheet are non-binding. So you are not stuck with anything that you're putting into that initial document. Then you might get to the due diligence stage. Now, we're going to talk a lot throughout this whole presentation on due diligence. In a way, it's maybe the most crucial part of the deal overall, because it really comes up at every single stage. It comes up at this initial stage when you're looking at a company to acquire. It comes up when you are drafting the agreements. And then it can also come up when you are closing the deal and you're trying to integrate this new company into your business. Then you'll have the purchase agreement, the main transaction document. You'll have other ancillary agreements that you might negotiate. And then you'll also have the post-closing issues that you'll deal with. So once the deal is closed, trying to integrate, again, that company that you've acquired, the business you've acquired, into whatever existing company you might have. Just a note, the due diligence process, again, because it is so critical, it is an ongoing process. You will start it at a very initial stage of the deal, but it will continue and often does continue right up until closing. Next slide, please. So at our initial stage, we are going to talk about due diligence. Again, you've highlighted or you found a company that you are interested in acquiring. Now you have to find out more about that company. Again, this is one of the most critical parts of the whole deal. John, next slide, please. So what is the purpose of due diligence? Again, this is where we're going to gather information about the target. We're going to find out all the known and unknown liabilities that might exist, the risks. We're going to find out information about the employees, the management, the assets. And as part of that, we're going to check and verify the purchase price. We might go into a transaction thinking that the company, the target company, is worth so much, but as you uncover any sort of issues that might come up in due diligence, you might adjust that purchase price, or you might structure it differently to account for any sort of unknowns. You're going to evaluate the structure of the transaction, and we'll talk a little bit more about this later. But should you structure it as a stock acquisition or an asset acquisition? Again, that's all part of the due diligence. As I mentioned, you're going to try and identify any sort of potential liabilities. What sort of unknowns are there? What sort of risks are there? What sort of big ticket items would you be acquiring along with the rest of the business? You're going to look at the assets that you're acquiring. And we're going to get into more detail on this when we talk about the IP. But what are you actually getting as part of this deal? What are you paying for? And again, due diligence is going to help us when we come to drafting the purchase agreement. It in part helps us tailor and modify the reps and warranties that we're asking the seller to provide. Next slide, please. So overall, due diligence really touches upon various aspects of a company. Oftentimes, the process works by a buyer putting together a due diligence request list. This is a list of things that we expect the seller to provide to us, either information or documents. And that request list can really vary in terms of length and detail. The shortest I've seen might be only a few pages long, and they can be very long, topping out at 30 pages or so. They're going to touch upon all different topics. So it's going to start with just the basic topics, the corporate documents. What does the company have in terms of its filings with the state? How was it formed? What sort of bylaws or operating agreement might exist? This will also get into who actually owns the company that you're acquiring, who has a right to maybe consent or block an acquisition. You're going to ask for contracts. Contracts are going to vary between any sort of financial contracts, banking agreements. It's going to go into employment contracts, consultant, distributors. It will also go into real estate. This is really just any sort of contract, whether it is written or unwritten, you're going to want to know about. Real estate and personal property. Oftentimes people don't have a physical presence anymore. So you might not have an office lease that you have to worry about. Personal property, what sort of tangible assets, again, would you be acquiring? Who owns those? Are there any sort of liens or encumbrances on them? Financials and tax. Has the company been filing all the necessary tax returns that they are required to file? Are they filing in all the states that they have to file in? Litigation. Again, this is a big ticket item. What sort of liabilities are there? Has the company been sued in the past? Are there any pending or threatened lawsuits that might impact the value of what you're buying at the end of the day? Employees and benefits. We're going to talk a lot about the importance of employees throughout this whole presentation here, but you're going to want to know the management, the experience of the company that you're acquiring. Compliance with laws is a big one, especially when it comes down to blockchain companies, because they can operate really cross-border and multiple laws can be applicable to that company and to their operations. And then IP, again, we're going to be talking a lot about the IP. So as I mentioned, due diligence overall oftentimes starts with this checklist that is prepared and then sent over to the other side. But there's a lot that can be done kind of behind the scenes at the initial stages. So some independent due diligence that you can do and your advisors can help you with is UCC searches. This is going to show any sort of liens or encumbrances that have been placed on the assets of the company. Litigation, again, is there any previous or existing litigation that's ongoing? IP, you can do searches publicly online of different IP that's owned by the company. And then social media is your friend here. This is where you can really start to look at kind of the management, look at people's LinkedIn profiles, Twitter accounts, whatever it might be, and just see who you might be going into business with. Next slide. So some due diligence challenges that you might face with these types of companies. As we mentioned, a lot of blockchain companies are just startup companies. In general, due diligence with startups is a little bit more complex. Sometimes they're lacking records that they might have, and information might not just be as readily available. Again, I talked about compliance with laws and the due diligence on that. Again, with blockchain companies, this is particularly important because it's not just that these companies are operating in one state. It oftentimes is cross-border, interstate. So you have to see what rules and regulations apply to these companies. Due diligence just takes long in general. A lot of times sellers get burned out. It's what we call deal fatigue. But specifically when it comes to technology deals, it just takes a little bit longer because it is so nuanced and you really have to dive in deep on some of these areas like IP. You have to have a good understanding of the status of the technology that the target company has. Is it fully developed? Is it commercialized? If not, how much would it take you to get it to that point, to get it to completion? And then again, going back to the employees and management, you really have to make sure that the target company has the skilled team that you need and competent team that you need. Next slide, we're going to get into some more detail about these blockchain transactions. Jennifer?
All right. So let's take a look at some of the nuances that really pop up when we're dealing with emerging technology and blockchain particularly. With almost all emerging technology, managing through a regulatory framework that's in flux is just difficult. When you stop and think about just digital assets as a general item, and we'll talk a little bit more in detail about it later, you probably have heard enough to know that it's unclear and there are changes that are really ever present and ongoing. So as you're going through due diligence, understanding where the regulatory framework is, where it may go, and how your acquisition of this particular entity, or even if you're selling, how your role fits in with a potentially shifting regulatory framework. Blockchain itself, it really is a nascent technology. It's growing. There are a lot of opportunities and a lot of possibilities, but there are some market sectors that are a little less tested and a little less proven. While people may know about Bitcoin, they may not know necessarily about some of the applications that could be used in the automotive industry or things that could be applied to healthcare. So some of these things are really kind of nascent, not a lot of experiential base out there, not years and years and years of successful application and implementation. And even more than that, certain blockchain-based technologies really do have a short life cycle, or it's really sensitive to kind of market flux. I mean, just, NFTs, Bill mentioned earlier, kind of the growth industry of NFTs. There are certain areas of NFTs that have already been kind of seen as flash in the pan, though. People wondering and questioning how long that particular aspect of an image of a cat that was purchased by a major newspaper, how long that asset's truly going to hold value. And let's just say Dogecoin to get that out there. The sensitivity of certain Bitcoin to just the tweets of people who happen to be president of, owners of powerful companies, just show you how market factors really truly can implicate the life cycle of blockchain technologies. Plus, as Laura mentioned, don't forget that so many of these targets do operate across multiple borders, whether it's state to state or internationally. And that does change the dynamic of an acquisition if you truly have a multinational company that's operating in so many different international domains, albeit digital domains. Next slide. So let's go and pop the cork a little bit on some of the things that Laura was really pointing at that can kind of create potential issues in the due diligence process. And the first one of those is intellectual property, good old IP. Starting out, when you look at a potential acquisition, can that seller even articulate what they're doing, what their intellectual property is? In this space, sometimes it's difficult because you may not have anything in the patent realm. You may have a brand like Dogecoin that may be powerful in terms of its brand impression, but are you truly protected with any trademark protection? Do you have a digital asset that may have some code-based or code-based plugins that you might have some protection under copyright law? Or is there really enabling technology? Is there know-how, these types of trade secret assets that are critical to truly helping the process along? Does the seller know what these are? And do we have any ability to see behind the kind of the cloak to understand what we're acquiring in any particular deal? And that's why Laura mentioned, for starters, that sometimes it takes a little longer in these types of transactions, because getting that understanding and kind of a mutual understanding between the buyer and seller can be difficult. And then going back, is all of the intellectual property truly owned by the entity that wants to sell? The more close to a true tech startup or to kind of these really emerging markets, the more of a tendency there is for individuals to retain their own IP ownership and to not necessarily assign that IP to the entity. For example, someone coming up with a particular digital asset, or somebody who came up with a blockchain application, they may have created a company around it, but never truly put it in the name of the entity, or have never set up anything to where the entity would be the true owner. In that case, it really could potentially frustrate a deal, or at least make it challenging to get started. And finally, is whatever asset either properly registered or properly protected? Again, not everything's going to be patent protectable. Maybe not everything is software that could be truly copyright protected either. So if it could be properly registered, has it been? But if not, if it's a trade secret, if it's kind of that secret sauce to make the entire system work, has the company properly protected that asset? Have all of the employees within the company signed confidentiality agreements? Have the assets been locked down sufficiently that someone visiting the office wouldn't necessarily be able to grab kind of the formula to Coca-Cola as they walked through? So these types of things in intellectual property are absolutely critical, and it just adds a layer of nuance when you are in the middle of an asset acquisition or even a stock acquisition, where that intellectual property is something that not necessarily everybody understands. And that's also key when you are looking to do these types of transactions, to make sure that you're working with both lawyers and if you're shopping through a broker, people who understand the technology to a certain degree. Because if you don't understand the importance of these particular propositions and understanding what the IP is or understanding what valuation is, you really could be potentially burned using a less sophisticated partner in these types of deals. Next slide, please, Jonathan. And this goes to, as Laura mentioned, kind of the notion of employee engagement as well. So what happens when you're looking really for what we call an acqui-hire or an acquire-hire type deal? I mean, let's just be honest. It's difficult to find people to work any job these days, let alone to do it in software development and engineering capacities. And particularly within the blockchain area, these people are highly specialized and usually fairly engaged. So there are a lot of acquisitions right now that are targeting exclusively the hire rather than truly hiring to fill these key positions. People will acquire the entire entity. A good example was in 2019 when Facebook acquired ChainSpace and ServiceFriend. It sped up their Libra and now Novi projects, and it's that acquisition-based, talent-based acquisition that really helped them out, because they just wanted the people. It wasn't necessarily any developed technology. It was the idea, I want these key talents. So due diligence in this area is important because you need to understand truly the competence of the talent involved. Does the person truly have the experience and expertise that they purport to have? And what happens when you start popping the cork and looking back at what their employment agreements are? What happens with respect to their ability to go off and compete against either the existing company or if you pick them up as a stock purchase, will they be able to compete against you in the future if they decide to leave? Very important areas to take a look at any of those restrictive covenants, non-competes, non-solicits as you go forward, because depending on the type of acquisition, you'll have potential different outcomes. Next slide, please. And that takes us on to valuation. And valuation, obviously, in an area that is comparatively untested, can be challenging. First, a lot of people will ask the question of, are there enough comparisons? Is there enough out there? Bill talked about how many different exchanges and different acquisitions are going on, but how similar are these? What history does the company that you're hoping to acquire have? Are there any other ways to truly do an effective valuation? And when you start looking at the reasonability of certain financial projections, you kind of bump into three traditional areas that are all very challenging within the blockchain spectrum. First, if you're looking at discounted flat cash flow, thinking about what's going on with the pandemic, with this technology, with unknown applications in multiple different arenas, there are really a lot of uncertainties. So the notion of using discounted cash flow is often kind of one that most people won't consider in terms of blockchain. So comparables, we can take a look at comparable companies. Here, the same sort of thing. An equity comp is difficult, particularly when you start inserting, when you're looking at 12 months of EBITDA and you have a pandemic in between. So understanding a company's cash flow and everything going through with just kind of the world we're in today will make any acquisition, valuation very difficult, especially in this technology area, because it's untested for the most part to begin with, and then insert that crazy variable of the pandemic. Finally, comparable transactions. there really are few transactions that are publicly available. Many of them, as Bill could tell you, are truly private transactions, and you may not have a sense of what that valuation actually is. So you're left in a position where I don't want to say you have to go to a degree on faith, but it makes that valuation exercise a lot more difficult because of the technology, because of kind of the current market situations and just the world in general. Next slide, please. So finally, we're going to pivot back, and I believe, Laura, we're going to kick over to you of what goes on when we get past and through that due diligence phase and we start talking about the deal and its terms.
Right. Next slide, please. So now we're to the deal itself and the documents that are going to reflect the deal. First of all, we've thrown out these terms before, whether or not you're going to have a stock sale or an asset sale, or a stock acquisition or an asset acquisition. A stock acquisition or an equity acquisition essentially means that you are buying the equity ownership of the target company. You are stepping into the shoes of the existing owners. An asset sale is more that you are acquiring only certain assets and certain liabilities of that target company. Sellers tend to like stock or equity transactions. It's easier from their perspective. They get capital gains and there's no residual assets that they have to deal with. They essentially sell and they are done. Buyers, on the other hand, tend to like asset acquisitions. With an asset acquisition, you can limit the liabilities that you are acquiring. You are not just taking the company as it currently exists. You get a step-up basis, and you can leave any sort of assets behind that you don't necessarily want or don't fit well with your company. So throughout the whole deal process, in addition to legal advisors, tax advisors are critical. And this is particularly true when it comes to structuring the acquisition in the form that it's going to take. So once you have your structure kind of set, you're going to go back to that valuation, that purchase price. And Jennifer kind of walk through some difficulties that there might be with setting a purchase price, with doing that valuation. But once that's done, you have to structure in your purchase agreement how you're going to pay out that purchase price. Are you going to just do a lump sum payment at closing and nothing else? Are there going to be some sort of deferred payments, for instance? Are you going to pay a down payment and then the rest over a 5-year, 10-year, 3-year note, promissory note? And if so, what are the terms of that promissory note? What interest might apply? What sort of conditions will there be? Will the seller retain any sort of security interest in the assets that you're acquiring as payment, as security for their payments under the note? And then there's also the possibility of structuring an earnout. Again, there would be a down payment at closing, and then there would be a structured earnout based on the performance of the company post-closing. So again, this could play a critical role if the technology is uncertain when you acquire it and you want to kind of test it out and make sure it's living up to the expectations that the seller sold you on. Now we get to the representations and warranties. And when you look at a purchase agreement overall, this is a good portion of what's going to be in the purchase agreement. So we've thrown out those terms before. A representation is really an assertion of fact that the seller is going to be making about something in particular. And the warranty is the promise that that fact, that assertion that's made is true. And the warranty is supported by an implied promise of providing indemnification if it is not true. So your representations and warranties that you'll see and you'll be asking for in a purchase agreement are really going to mirror a lot of the same things that we touched upon in due diligence. You're going to want the seller to represent and warrant that the owners that they presented to you in due diligence are the true and correct owners of the assets or of the equity. You're going to talk about IP. You're going to address employees and benefits. If there is any sort of physical brick and mortar location, you're going to talk about the real estate. This is, again, it's going to touch upon everything that came up in due diligence. And as we've seen before, IP is going to be a critical one, and we're going to get into more detail on that. As we talked about in the due diligence stage, the representations and warranties and the due diligence that backs those really are used to allocate risk. So again, you're going to be asking, or buyer is going to be asking a seller to represent what they are selling to you, what their business is, what their company is. And if they don't stand behind those, then the buyer would be entitled to certain indemnification rights. And this is kind of, their backstop at their pain. And if you don't live up to your promises, you're going to have to pay us back, or there's going to be other remedies. So in addition, the purchase agreement, and as part of your due diligence, you're going to want to look to see what sort of consents or approvals would be required to actually close the deal. And this can really range from getting consents or notices from the owners of the assets or the equity. It can be any sort of customers that might be involved in the business. You might have a change of control provision in certain contracts that would require consent or notice to be provided prior to a deal closing. And when we talk a little bit more about regulatory issues that come up, there could be even governmental consents or approvals. When Bill was talking about kind of some of the past deals that have been going on in recent years, when you get to those big numbers, you're going to be talking about getting sort of consents from federal agencies to make sure that you can proceed with the deal before you actually close it. Next slide, please. So continuing in what you might see in this purchase agreement, you'll often have covenants, and covenants are essentially a promise that one party to the deal makes to the other parties or party to either do or not do something. So basic terms, this can come down to confidentiality. When you acquire a company, you're going to want the sellers to make sure that they keep the confidential or the information that you're acquiring confidential. You're going to have the indemnification provisions. What happens if there's a breach of a representation or warranty or a covenant? There might be certain insurance requirements. And then again, Jennifer had talked about the non-competes and non-solicitations. So after you acquire a company, you're likely going to want the seller, if they're not working for you, to be restricted from turning around and starting up the same exact business the next day. And even if they do start working for you, you're still going to want some sort of non-compete and non-solicitation provisions when they cease working for you. So we've talked about indemnification a little bit. What kind of holdbacks or escrows are there going to be for claims? Again, this might be with the purchase price that at closing, you're going to set aside a portion of that purchase price. And that's going to be used for any sort of post-closing claims that you might want to make against the seller or the company. This could also be used while you're testing out the technology, again, until you know that it is what the seller told you it is and that it works. You might set aside some money from that purchase price so it doesn't go directly to the seller. Indemnification for possible breaches, we've talked a bit about. Oftentimes the purchase agreement will not only address indemnification for breaches of reps and warranties or covenants, but it will also allocate kind of my watch, your watch. So anything that arises or occurs prior to closing, prior to when you own the company, would be a liability that the seller keeps. And then any sort of actions or liabilities that arise after you own the company is your watch. One important thing to keep in mind is that the ability to go after a seller can be difficult at times. And it also is impacted by the structure of the deal. So we talked about the difference between a stock and an asset sale. Well, in an asset sale, the seller oftentimes will sell all their assets. So they kind of just have a remaining shell company afterwards, and they might just liquidate that company. So if you as a buyer try and go after them post-closing for some sort of indemnification claim, what's left of that selling company? Likely not much at all. With a stock sale, oftentimes you'll have multiple owners, multiple sellers. So again, if there's some sort of post-closing indemnification claim that comes up, buyers are stuck chasing after multiple sellers to get reimbursed for whatever sort of damages there might be. In addition to the purchase agreement, which is going to be the main document in the deal, you'll have ancillary agreements. So if you do decide to have a holdback or an escrow of the purchase price, you'll likely have an escrow agreement. You might have employment agreements that you enter into with key management of the target company. You'll have those restricted covenant agreements, the non-competes, non-solicitations, and there will be other documents that you'll be asked to either deliver yourself as a buyer at closing or ask the other side to deliver it. Now, some things that we're not going to go into much detail here in terms of the purchase agreement itself are you might have sections in the agreement that talk about conditions to closing or termination rights if it's set up as a separate sign and close. And as Bill has mentioned on other topics, this could really be a whole discussion of its own. So again, we're not going to go into much detail now. Next slide, please. So one thing that you will want to address in the purchase agreement is dispute resolution. What happens if there is an issue? And some options here are just plain old-fashioned litigation. Either party could bring a lawsuit in whatever sort of jurisdiction you might set out in the purchase agreement. You could also put in mediation or arbitration. You could just put in a requirement that the parties try to mutually negotiate and agree to some sort of compromise for a period of time before you go on to litigation, mediation, arbitration, whatever that might be. And something to keep in mind, though, when we're talking about acquiring these really technology and IP-based companies is that, again, it's very nuanced. So you want to make sure that whatever sort of dispute resolution you're putting into your purchase agreement makes sense for the type of business that you're buying. Disclaimers, oftentimes sellers are going to want to put in all sorts of disclaimers in the purchase agreement and other documents. You know, they don't want to make certain reps and warranties to you as a buyer, or they want to disclaim kind of the projections about the company, where it's going, what it's worth. So it's just something to keep in mind. And then, as we talked about with the due diligence, tech agreements and the negotiation of it can oftentimes take a lot longer. It's just much more complex than when you're acquiring some other types of businesses. And when you get into those indemnification rights and the holdbacks and looking at the technology. Next slide, please.
All right, so let's pivot back to the workforce for just a minute. If you are going through an exercise that is in kind of the hope of acquiring people, you really have to realize that in these types of deals, people do get a little sketchy as an employee, but you know that you want to retain as many employees as you can. Now, depending on whether you have a stock or an asset purchase, you might lose your restrictive covenants. So kind of those non-competes and non-solicits that we talked about earlier and that Laura mentioned. A lot of times when you have an asset purchase, those agreements don't necessarily carry through. So you want to make sure that you're considering having the seller engage with those key employees. Again, the ones that you have found that you do want to keep through your due diligence. Try to engage them with new restrictive covenants, but don't forget at the end of the day, employees tend to be at-will employees. And in this instance, they might have the will to get up and leave. So be very careful when you are doing those types of acquire, hire, or acqui-hiring agreements. It's really dicey if you're not truly sweetening the pot sufficiently to keep these employees where they are now. Next slide, please. And then reps and warranties. Now, we've talked about the sensitivity of financials. We've talked about the sensitivity of intellectual property. And Laura mentioned, again, some of the liabilities. When you're dealing with a blockchain company, these are really absolutely critical because you do want to understand certain things in the financials. You want to package it tightly and make those representations and warranties very tight so you have a good understanding of what's on paper when you get the deal done. Just to break out one example, intellectual property, you want clear representation and warranties talking about infringement risk. You want to understand the underlying technology, particularly if anything you're acquiring has software, and particularly if you're acquiring something that has either open source software or something has copyleft in it. Copyleft, the term kind of suggesting that there are rights and licenses that have to be passed on through, and the opportunity for the next acquirer or the next user to be able to use those licenses and forward them on. Things like that you want to be very cautious of, and particularly in IP, making sure there are no encumbrances, because IP, you don't always find those filed with the UCC. So you'll want to make sure reps and warranties on ownership, that ownership is with the right entity, and you want to make sure that those things are unencumbered. So really, reps and warranties, you need to take your time and think through, really with respect to the technology, what you're acquiring, and making sure that those points are as solid as possible. Next slide, please. And Bill, I know if you could come back and join us for a second and tell us about kind of the known unknowns.
Yeah, so happy to do it. So known unknowns, right? When we have this here, what we're referring to is really the foreseeable risk of regulatory or legal issues related to these kinds of transactions. And, as has been touched upon, we could occupy an entire webinar just on these items, but suffice to say, the takeaway here is parties to transactions and blockchain businesses need to be looking around corners because this is a unique regulatory landscape. So I'm going to quickly talk about some of the key concerns. It's not a, complete list, but highlights some of the main pressure points. First and foremost, antitrust. It is no secret that lawmakers have been increasingly focused on the antitrust implications of tech and big tech in particular. Companies like Apple, Amazon, etc. Just last week, the House introduced legislation that would make it easier to break up large tech companies. And I think there's a lot of interest and concern about the intersection of tech and privacy and finance. And we are seeing these priorities expressed. So be very cognizant of your antitrust applications or implications, sorry. Next, we've spoken in the past, and we actually did an entire webinar on financial regulation. But suffice to say, various financial regulatory agencies in the United States have taken a very aggressive role policing the digital asset industry over the last couple of years. And if your blockchain business is tied to a new token or a pre-existing digital asset, say you're accepting Bitcoin for something or sending crypto for something, or in the financial services space at all, really there's a broad spectrum of regulations that we might need to think about here. So what are some examples? Well, a new token, if that's the business, might be deemed security by the SEC, and that is a very complicated area to try to navigate. Use of digital assets might also constitute the use of convertible virtual currencies or CVCs, giving rise to reporting and compliance obligations. Transactions with foreign entities using digital assets might give rise to obligations regarding foreign asset control. There also might be state level requirements. Folks might not think about it, but depending on the nature of your business, you might need to be licensed in a state as a money transmitter. So, those are just sort of the broad spectrum of items that you might have to think about in the financial area. But there's also sector specific requirements that are going to generally apply to corporate transactions. That you need to think about automotive, healthcare, data protection laws, critical technology laws all apply here or may apply here, just to name a few examples. And while I don't believe that any of these regulations are insurmountable, I think the common thread that folks need to remember is that regulators looking at blockchain technology or digital assets are often trying to apply old laws to new tech. And this can have the effect, at least in my world, of financial regulation, of making regulatory compliance a bit more difficult than you might see in a traditional transaction. Say one big bank acquires another small bank. That's one thing. What do you do in which it's the bank now acquiring a crypto payment processing solution? Guidance might be in short supply given that this is a new tech and folks are trying to figure out how we regulate this. So while every situation is fact dependent, parties to transactions in this space would do well to tread carefully, get good guidance, and think about, the knowns and the unknowns. So hands back to you, Laura. Next slide, please.
Thanks. So congratulations, you have bought a company. Now what? Now we've talked about all different important critical steps of this process, but really the integration, the post-closing integration is probably the most significant, if not one of them, part of the long-term success of the deal, of the company that you've bought, of your existing company. And one of the things throughout this whole integration process is this balance of autonomy and integration. You don't want to disrupt the norm too much, but you still want to bring in the strengths that your existing company has and kind of blend those two together. And again, you know, my favorite term here, due diligence, the importance of due diligence. Due diligence can really help with the post-transaction integration. The more you learned about the company, the people, their processes throughout due diligence, the easier it's going to be to kind of do that integration post-closing. So there's different types of post-transaction integration that we're going to be touching upon really briefly now. I'm going to throw it back over to Jen for the technological integration.
All right. So what's interesting about technology and integrating it, a lot of the failures happen right at the beginning. As a matter of fact, 70% of integration problems start right at the beginning of the integration, not at the end. So pay a special amount of care up front. Just understand that if you're purchasing it, your experience really plays a part in how well integration is going to go. Do you understand the unique history of blockchain? Is your culture sufficiently agile to take in this type of a company? And really, it's going to depend on whether you're fully integrating this new technology into your system, or you're just kind of doing a bolt-on, bring it on board and we're taking it as is, or a tuck-in type acquisition. Next slide, please. And what that goes down to is this: for technological integration, it starts with your people. You need to understand who your key tech resources are, and you need to understand their skill set. So be honest about your readiness, honest about the skill sets, but it leads with people. And then it follows with processes, mapping your processes as you bring in that new technology and looking for any interdependencies, because you may acquire something that will have multiple layers of technology and multiple layers of information. Figure out what you need to keep, enhance, or replace based on those interdependencies. And finally, while you're going through this process, don't forget your cost management. It's very easy to get cost overruns when you're integrating technology. You need to be cognizant and mindful of that as you're bringing tech in. Next slide, Laura.
Right, culture integration. Jennifer's always talked about people and the employees, and this is really important for making sure that you maintain those key people that you want at the company. Oftentimes, integration is so focused on minimizing costs and capitalizing on strengths that we kind of forget about the importance of the culture. So in addition to just figuring out how do you blend together, how do you integrate some basic things like the compensation, the management, the benefits, the overlapping positions that might occur. You also have to think about how do you integrate the culture. And this can specifically or particularly be true when you have a tech company that you're acquiring and you are not a tech company. Tech companies and their culture can differ from non-tech companies. It's rapidly changing. There's a risk to really drive innovation. The structure of management and roles is a little bit different. Again, we've talked about kind of the importance of key employees and skilled employees. So we want to make sure that those individuals stay and are happy. So part of it is just evaluating and assessing, what do employees want? What do they not want? A lot of the times tech company employees want a collaborative environment, open space, continued growth, access to the best technology. And those might not all be things that you have at your existing company. You want to keep in mind morale and productivity. Oftentimes the best advice is really just to be open and communicate any sort of changes that you're making post-closing. Explain why those changes are necessary, and really open the floor up for any sort of issues that employees might have. Next slide here. And then the last thing is really the legal integration and compliance. Again, it begins with the due diligence. So you want to, in the very initial stages, address and identify any sort of remediation that needs to be done post-closing. This can particularly be important, again, when you're dealing with companies that operate internationally or across states. You want to make sure that you're complying with the applicable laws. Are there any sort of new laws that will apply because you've now acquired this company that operates in different locations? Are there any sort of permits that you might need, other licenses? What sort of regulations might apply? There's also the privacy and other obligations from pre-closing that continue post-closing. Oftentimes when you do your due diligence, you're going to want to make sure that the buyer's privacy policies are either segregated post-closing or integrated, and you continue with those obligations. The privacy laws regarding sharing of information is important when you start integrating companies. Data migration can have limitations on the sharing and transferring of data. And then finally, there's software licenses or other sort of licenses that might apply and might limit how many people use those post-closing.
So Laura and Jen, thanks so much. I think we absolutely nailed the timing here and managed to go through a whole lot of content in 60 minutes. So thank you so much for your awesome contributions. I think this is very instructive and helpful for our audience. Given the time, and I want to be cognizant of folks' schedules, we've got our contact information there in the bottom right. Please, if you have any questions that you would like us to work through, or you need some legal assistance, please feel free to reach out to myself, Jen, or Laura as appropriate. And Jonathan, if we could have the next slide. Our customary reminder, of course, that all of this is just intended for informational purposes and every situation is highly fact dependent. If anything, this presentation should impart upon you that, this is a highly fact dependent and complex area that should be navigated with the help of professionals. So the help is out there. Please, feel free to make use of it as you consider a blockchain transaction. With that, thank you once again to Jonathan, our moderator, Laura, and Jen, for that outstanding content. And thanks for everyone who was able to attend. A recording of this presentation will be available on butzel.com as well as YouTube if you would like to watch it. Thanks and have a good day.